The problem isn't that gold and silver don't work. The problem is that most people hold the wrong amount. And an environment like 2026 won't ignore that mistake. Why this conversation matters. Most people assume that owning some gold or silver automatically means they're protected, like just having a little exposure puts them on the safe side of whatever is coming. That assumption feels reasonable, but history shows that's not how financial stress actually works. In almost every major monetary transition, the people who believed they were prepared were often the ones who weren't. Not because they owned the wrong assets, but because they owned too little or misunderstood what those assets were supposed to do. That's why this conversation matters now. Protection only works if it's in place before stress becomes obvious. 2026 is not a normal slowdown. A lot of people are still thinking in terms of normal recessions. A bad year, a market dip, then things go back to normal. But what we're moving toward doesn't look like that. This isn't just about slower growth or higher unemployment. The pressure is structural. Government debt levels are high enough that they can't be handled without inflation or financial repression. Central banks are stuck choosing between protecting currencies and protecting markets. And when they're forced to choose, history shows markets come first. That decision slowly erodes purchasing power. Not all at once, quietly. That's what makes this environment dangerous. People don't feel the damage until it's already happened. What gold and silver actually do, one of the biggest misunderstandings, is thinking gold and silver are supposed to make you rich. They're not growth assets. They're insurance. And insurance only works if it's sized correctly. Gold and silver don't eliminate volatility. They don't stop markets from falling. They don't remove risk. What they do is protect purchasing power during monetary disruption, policy mistakes, and confidence shocks. They work when trust weakens. They work when real yields are suppressed. They work when paper assets depend on policy support. That's their job. Nothing more. Gold and silver are not the same. Treating gold and silver like the same asset is a mistake. Gold is primarily a monetary asset. It's more stable. It's globally liquid. It hedges against currency debasement. There's a reason central banks continue buying gold. They're reducing counterparty risk. Silver behaves differently. Silver is both a monetary and industrial asset. It's used in energy systems, electronics, medical technology, and defense. That creates more volatility. Silver often moves later than gold, but when it moves faster. That creates opportunity but also risk. Holding one without understanding the role of the other creates imbalance. What enough really means? Most people want a simple answer. A number they can copy. 5%, 10%. But allocation doesn't work like that. Enough depends on your situation. Debt, income stability, exposure to the financial system. Someone with high debt and limited savings needs more protection than someone with low debt and diversified income. Enough is not arbitrary, but it is personal. A better question is this: can you hold your metals position without constantly second-guessing yourself? If you can't, something is wrong. Either the size is wrong or the expectations are. What history shows. History is clear about one thing. Token exposure feels comforting, but it doesn't change outcomes. Very small allocations rarely provide real protection when purchasing power erodes. They feel responsible, but they don't move the needle. On the other extreme, oversized positions create liquidity and volatility problems. Meaningful protection usually sits somewhere in between, enough to matter. Not so much that it creates new risks. Liquidity matters. Metals are not as liquid as cash or stocks in every situation, especially physical metals. That's part of their strength and part of their limitation. You never want to be forced to sell protection assets to cover short-term needs. That's why metals should sit on top of an emergency buffer, not replace it. Skipping this step is one of the most common mistakes. Sequence matters. Events don't unfold all at once. Inflation comes in waves. Policy responses lag. Markets swing between calm and panic. Gold and silver respond differently at different stages. Gold often moves first during confidence shocks. Silver tends to accelerate later when inflation becomes visible. Understanding this helps prevent emotional decisions. The psychological side. Metals can feel boring. That's normal. They often do nothing while other assets are outperforming. That's the cost of insurance. People who can't tolerate that discomfort usually sell right before metals become valuable. That's why enough isn't just a number. It's an amount you can hold without panic. Physical versus paper. The difference between physical, metals, and paper exposure doesn't always matter in calm times. It matters when trust erodes. Physical metals remove counterparty risk, but add storage and liquidity considerations. Paper instruments offer convenience, but depend on system stability. Many people don't appreciate that difference until stress arrives. Rebalancing. As metals rise relative to other assets, their share of a portfolio increases. Trimming restores balance. When metals underperform, adding modestly restores balance. This process removes emotion. Structure holds up under pressure. What 2026 really tests. The question isn't whether the system will function, it's who it will favor. Systems under stress tend to favor debtors and institutions. Savers usually pay the price. Gold and silver don't remove you from the system. They give you distance from its weakest points, but only if they're held in meaningful size. Final thought. Gold and silver aren't bets on collapse. They're acknowledgements of limits. Limits to debt, limits to policy, limits to trust. Enough is the amount that lets you sleep at night while staying flexible. The amount that protects purchasing power without forcing reactive decisions. The people who do best aren't the ones who predict perfectly. They're the ones who position thoughtfully, size correctly, and stay disciplined. Gold and silver aren't shortcuts. Used wisely, they're tools.